When it comes to building world-class digital businesses, IAC is in a league of its own. It's successfully grown dozens of popular online brands and services that are used by millions of consumers every day, including Match, Vimeo, Angie, and Dotdash Meredith. I'm delighted to be joined by IAC CEO Joey Levin, who's going to share their approach to building market-leading businesses, where they see opportunities arising from disruption, and what's to come in the future. Joey, welcome to the Macquarie Technology Summit. Thanks for making the time.
Thanks for having me.
For those who may not be as familiar with IAC, you've spun out 10 public companies and created, I believe, around $60 billion of shareholder value. That business model, why does it work?
Well, we've called it the anti-conglomerate. So most, or not most, I should say, but a lot of companies, when they are succeeding, they hold on to their best businesses and then get into lots of other businesses. But what we found is that a business can reach a certain size and a certain scale where, in fact, it is probably better off on its own. It's in a sense like children outgrow the house or with their parents. It makes sense to go out and do things on its own. And in each case, there's a different reason. They probably are all similar, but in each case, there's a different reason. It might be they need access to a currency. It might be they need access to a currency for M&A or for compensation. It might be that it's the right thing for that current leadership or leadership structure. And whatever the reason is, we think that as shareholders and for our shareholders, it makes sense for companies to do what is right for the structure of that individual business and for the thing as a whole. And when those two things come into line, meaning for IAC as a whole and for the individual business, we want to spin it off and not sort of keep it stuck in that structure. And what we've found is that most often the businesses can, if we do it at the right time, go on to thrive.
And how's that model evolved over the years?
We didn't start out with that plan, and we didn't really do it on purpose. The first time we did it, it was Expedia, and it was the right thing for Expedia. And what had happened at that time was Expedia had gotten so big relative to the rest of IAC that everything else we were doing in IAC became sort of irrelevant. It was all in the shadow of Expedia. So it was, we could be building businesses. It was okay, but how many room nights did Expedia sell? And that was kind of the focus. And we thought, well, if that really is the focus, let's let it live on its own and go back to focusing and building again. The other thing it does, which I didn't mention before, but it forces us, when we spin off the big business that has its own scale, it forces the rest of the infrastructure of IAC to make the little things grow because they matter all of a sudden. And I think that amount of focus allows us to build from there. But after we did the first one, then we did another one, and then we said, okay, this is a pattern, and this is something to embrace because it makes sense, and then it started to become an objective.
Right. And so recently you spun off Match and Vimeo, and if we look at the other end, you mentioned the smaller investments. It's an interesting valuation environment. You've created a lot of long-term value, as we mentioned before. How do you think of those emerging businesses now in terms of the capital that you're putting into them compared to investing in the public markets?
Yeah.
And maybe some examples. Turo looks like a fascinating business.
It is.
But you're also looking at Web3 and crypto, the staffing models with Vivian and so on. It's such an eclectic mix. How do you decide where to invest within that?
Yeah, the best and worst part of my job is that we really can do anything in any area and at any stage. And so it is something that it's fun to learn all kinds of new things, but it's also something where anything we didn't do is something we missed out on. If we're in the business of looking at all these businesses in all these different areas, then we really should be finding winners and opportunities everywhere. So it's hard. Our two most recent spins or separations, Match and Vimeo, those were tiny businesses in IAC at one point. Match started as part of IAC with a $50 million acquisition, and followed by another $40 million acquisition, and has gone out to be multiple tens of billions of dollars company. But that was a tiny business, and it was also at many points in IAC's history, sort of from a external shareholder perspective or the dominant narrative perspective, it was totally irrelevant. That was true for a very long time, actually, for that business before it became what it is. And the same was true for Vimeo. Vimeo we bought as part of a different acquisition. We were actually really focused on a business called College Humor. And that had two businesses that came with it. One was called Busted Tees, which made T-shirts, and the other is called Vimeo. And we said, well, there's this little Vimeo thing has potential, but our main thing is we're in the content business and trying to get into the content business with programming at College Humor, and Vimeo could be interesting. But that entire acquisition was maybe a $30 million acquisition, of which Vimeo was a footnote. And then for many years, Vimeo was still kind of a footnote. It was irrelevant. I had meetings with shareholders where they'd say, why haven't you shut this thing down yet? And then it gone on to spin off and be a multi-billion-dollar company as well. And people forget because they only sort of focus on the successful period and the successful story in the most recent period. But all of our businesses took many, many years to build and many, many years to develop. And that's what we're in right now. With some businesses are in the more advanced stage, and some businesses are still in a very, very early stage. I mean, we have a business called Vivian, which is matching healthcare professionals with employers, and it's a teeny tiny business. But could that business be a billion-dollar, tens of billions of dollar business? Yeah, absolutely. If we're doing, if we execute on what we think is possible, it will be, but it won't be anytime soon.
And the valuation environment, obviously, we've seen a lot of volatility lately, but you've demonstrated outstanding discipline through the peak of the cycle. And then you've gone and invested with a lot of courage in businesses like MGM and now Meredith.
Yeah.
Can you give us a flavour for that period of time 2 years ago, over the last year or so? You wrote a $2.7 billion check for Meredith, which is in print.
Yeah.
And then in MGM, at the depth of COVID, made a large investment.
Yeah.
Can you take us through the thinking at that point and how you had that courage and support?
Well, they're all different. So it's funny, over the last few years, we have a M&A team who's very good, do a lot of work. They're all sitting right up there. But they have all grown up in basically a bull market. And so I would have meetings with the M&A team where we would go through ideas of companies we could buy, and they'd say, well, we're talking to this company, and it's interesting, and it's doing this wonderful thing, and it's got a lot to prove. And the valuation's around $2 billion. We think we could get in at that. And I'd say, okay, I'm looking at this thing. It looks to me like it's worth about $20 million. And they would get very frustrated with me, understandably, because they'd say, what planet are you on? This isn't right. And I'd say, I understand that something similar to it traded for $2 billion and somebody else wanted to put money at $2 billion, but it's just, there's so much risk in this thing. There's so much that still needs to be proven. You just can't put that to work. And that was a frustrating process for some period of time to hold on to those things. And what we had to do in that window was look in places further afield. So one was to go earlier. So you made reference to our incubator where we're doing Web3 things. One was to go earlier, and the other was to go at things that I'd say, had some scratches or dents on them. And I think that's true of the print magazine business. We bought that at 7 times EBITDA at a time where not many things traded at that multiple. And it deserved that multiple because it was a declining business in a category. Print magazines are not a growth area. But we had a particular angle, which is we had a digital publisher called Dotdash that was executing fabulously well, where one of the opportunities to grow that business was to buy brands that users had a natural affinity for, but that hadn't exploited their digital potential yet. And that was the thinking behind that deal, and that's what we're executing against right now. So, for example, we moved the first site from the Meredith platform onto the Dotdash platform a a few months ago, or a few weeks ago, sorry, and it is immediately, the site is like multiples faster than it was. We took down a whole bunch of ads, but we're still monetizing it better than it was monetizing. And it's starting to get real traffic increases. And that's because we're doing the things that we know that users want in terms of content online. And if we can continue to deliver that across all the Meredith properties, I think that sort of notwithstanding whatever happens to print, and I do think print probably actually lasts forever, because we view it as kind of a luxury product right now, and we're treating it accordingly. But notwithstanding what happens to print, we think we can create a lot of value there by building compelling digital products for people.
And in terms of the advertising market, digital advertising, how is it evolving? We hear a lot about the privacy changes.
This is changing a lot. I mean, Apple's ATT, which is what they've said is a privacy issue, I think is more a competition issue. But there's a lot of battles between the huge players, Apple, Google, Amazon, Facebook, for what the rules are. Obviously, everyone's rules that they think are the right rules for the consumer and privacy or whatever serves their business the best. But that's okay. We know how to play in each of those platforms. But one of the things that's fundamental to our digital advertising business, which is the vast majority of what Dotdash Meredith is now, is we actually don't need any of this private information, because our content alone tells the advertiser what the user wants. So just as an example, if you're looking for these beautiful Italian suits that you wear, we know
Australian one.
we know that you're looking for suits, and so a suit advertiser can reach you there. And maybe we can make a second step, which is, you're looking for suits, you might also be looking for ties, you might also be looking for shoes, or if you're looking for a certain type of suit or brand of suit, you might be of a certain income level or something like that, or there's other things that might tie to that. But we don't need to know who you are. We don't know who you are. We don't need to know who you are. We don't need to track you. All we need to do is say, here's a person looking for suits, and here's a way for an advertiser to reach them. And what happens in that scenario is the ads perform for the advertisers. And so the advertisers come back to us more often, and we don't ever need to collect that information. We can collect that information, and some advertisers want that, but generally our ads can perform without any of that information. And that's different than, for example, if you're in the news business. If you're in the news business, lots of different people read the news, and then you have to impute from that what they might want, or say, well, we want to reach these people because they're interested in news. But for us, it converts because the user's telling us what they want, and also that makes the ad more relevant for the user and more welcomed by the user because it's for something that they're in the market for.
But what about the demographics? I know you probably Better Homes and Gardens. I saw you put Harry Styles on the cover. That was probably your call. But how do you, in terms of the youth market and the established print media viewers or consumers, how is that demographic shift impacting the way you approach the business?
Yeah, we absolutely have to bring it to a younger audience, the brands to a younger audience. So the brands do resonate with a very wide audience. It's not just an old audience, but it is not, I shouldn't say resonate. The brands are recognized by all the audiences, which is a huge leap forward from where we were. I mean, we were creating brands from scratch, and creating a brand takes 10, 20 years. We were creating these from scratch, and the Meredith brands have existed for, in some cases, 100 years. So the brands are known, but they may not be resonating. And so, bringing somebody like Harry Styles to the cover of Better Homes and Gardens is engaging a very different audience than has historically been engaged there. And I think there's an opportunity to do that across all the brands. I mean, even something like People Magazine, it's a fantastic product. People love People Magazine. But we haven't, I don't think, yet engaged the current class of celebrities or the younger class of celebrities in the same way we have the older class of celebrities, and that's an opportunity to bring that younger. But there's certainly a lot of interest in that content.
Right. Joey, Turo. Love to hear your thoughts on Turo. Obviously, climate change, energy transition, there's a lot of discussion about EVs, but car sharing can contribute also to the climate transition. How do you think of the Turo opportunity?
Sure. So I think Turo's mission is, I mean, I get it word for word right, but the gist of it is putting the world's billion cars to better use. And the cars are out there. So let me explain what Turo's platform is, which is it's peer-to-peer car sharing. So anybody who owns a car can put that car up on the platform to effectively rent it out to anybody who needs a car. The amazing thing of that is cars are significantly underutilized. I mean, anybody who owns a car knows they're not using it all the time, and there may be actually long periods of time where you're not using it. And this platform allows you to monetize that. So we see allows the owner of the car to monetize that, and at the same time, it allows a user to get access to a car they may not otherwise have access to, which is generally going to be unique on both the type of car. So there's a wide range of cars available, whereas in a rental car, for example, they're buying cars in bulks, and so they're all fitting at certain parameters. Turo, there's a very wide range. The other thing is location. So somebody can bring the car to you a very short distance, or you can go get the car a very short distance, but they're not all concentrated in airports or in particular locations. That distributed base of cars and that distributed inventory of cars is just a fundamentally better experience. So there is also a great feature, which you've alluded to, which is number one, where we moved much faster on electric vehicles just because users were moving faster on electric vehicles, and we didn't have to go and say, okay, let's purchase a fleet of 400 vehicles or something. Our users have the vehicle, or 400,000 vehicles. Our users have the vehicles, and so those are available. It's a great place to try out an electric vehicle or use an electric vehicle if that's what you want. And also, utilizing underutilized assets is better for the environment because you don't need to produce as much. It sort of hit a lot of notes at once. A lot of people doubted it. A lot of people had questions about it, which is, would anyone really want somebody else driving their car? Would anybody really want to drive somebody else's car? But the community has really come together to deliver a compelling customer experience, and it's a fun one to be involved in. Yeah.
And if we look at the labour market, you mentioned Vivian before, which covers healthcare professionals, and Blue Crew. What insights is that giving you into the labour market currently that you can share with our audience?
Yeah, maybe the most interesting trend, and you can see this with the quote-unquote gig economy work like Uber or DoorDash or things like that, is the people want to choose their own hours. They don't want the fixed 40-hour work week or even 20-hour work week, whatever it is. What platforms like ours are doing and going to be able to do is meet the worker where they want. Meaning it might make sense to work 3 hours on Tuesday and 8 hours on Thursday and whatever the schedule is to balance other needs of the worker. And technology can make that pretty easy for people. And so if you have software that can parse out that work, parse out the needs of the worker, the needs of the employer, and put that puzzle together, I think that's going to be very compelling. And one of the reasons I think that a lot of people are having a hard time hiring right now is because specifically that they're trying to fit everyone into the same formula of how hours work. And the reality is that for, I think, the next generation of workers, they don't want to fit into that formula, and they don't need to. And technology can enable people to fit in a different formula for how to assemble a work week. And it may be multiple jobs, it may be multiple employers, it may not be multiple, but it may be a schedule that works with respect to kids or raising kids or education or other things that work for the worker.
MGM, as I mentioned before, you invested at the depth of COVID, I think at $12, it's traded as high as $50. The online iGaming models and evolution, what can IAC contribute to MGM in that capacity through BetMGM or otherwise?
So if you'll go back to how MGM started in the iGaming and digital sports betting business, it was a joint venture between MGM and a UK company now called Entain. And the reason they did that was because MGM was not familiar with using technology and using modern technology, and so wanted a partner that could deliver that. And one of the things and then they were able to rely on that partner for that component of the partnership, where MGM brought brand and customers and licensing and things like that. What we're helping with MGM is to build the confidence and the infrastructure to be able to own its destiny in technology. And that's just having experience in that area and having a network in that area and people in that area and the confidence to get started in that area, which is a really hard thing to do. I mean, any institution, we do this ourselves, or make this mistake ourselves frequently, which is you're doing something, you're very good at doing something new comes out, and you can't adapt that quickly to doing that new thing because all your people and infrastructure is built around a prior way of doing it. And so we come in with that experience on that part of the business and can help sort of build the organization, build confidence around that to be able to deliver. And it's been amazing how well, this is no credit to IAC, entirely credit to MGM and the BetMGM joint venture, is how amazing that business has done relative to where it was when we got started in it. And they just have continued to believe in it, to invest in it, and to gain share in that area. But our main thing getting into MGM when we did at the depths of COVID was just saying, this is a premier asset. This is a category leader. This has incredible cash flow when the world comes back to normal. We believed the world was coming back to normal. And then on top of that, it had this incredible digital option, which we thought we got for free, essentially, in there. And I think that's turned out to be a pretty valuable option.
We talked briefly about the valuation environment, and you've been disciplined, focusing on discounted cash flows. You're also in a unique position where you have visibility into public markets and private markets and the flexibility to invest in both. Where do you see the market overall going, whether it's the private and public markets?
Yeah, I think private still has a long way to go down. And I think that the public markets are probably stuck where they are for a while. I mean, maybe down a little more, maybe up a little bit, but generally in a band. I mean, just on simple math, for the high growth tech companies that are down by 80%, one good quarter doesn't lift your stock by 400%, which is what it would have to be to get back. That's, if you have a good quarter or whatever, you're moving up 10, 20, 30%, I don't know, you want to be very aggressive. That's multiple years of great performance to get back to 400% increase from where things are right now. And it's different than COVID, which is, everybody ran and hid very quickly because nobody knew what was going on in the world. And so that was a temporary, suck all the liquidity out of everywhere and then very quickly bring all the liquidity back. We're not in that environment right now. We're in an environment right now where people are saying, okay, let's be more rational about these things. And risk does have a cost. And if interest rates rising makes that clear, inflation also. And this capital does have a cost. And so people are adjusting their views on valuation. It's not the kind of thing, in my point of view, that just snaps back. I don't see that happening. It's just now from here, we have to grind out earnings. We have to grind out growth. And that's hard work. That takes a while, and you got to deliver. And I think valuation will increase as people grind out growth and earnings, but it's not, those multiples aren't coming back anytime soon.
And down rounds for the private companies, how do you see that working? How does it?
Well, the great news about a private company is you don't have to see a share trade hands. So if you have enough cash on your balance sheet, there's no reason for a company to crystallize the reality of what's going on around them. They can avoid that for a while. Now, at some point, they're going to need to, but maybe they can, if they have enough capital, they can ride it out through the next cycle or ride it out until the earnings catch up. But if any of those companies were doing current rounds, for probably 99% of them, they would have to be dramatically down. But many of them can avoid that and confront it later.
Within the portfolio, clearly you've got a lot of growth potential in all the segments that we've covered. But looking at some of the newer opportunities around Web3 or even the metaverse or whatever keyword or concept we talk about, what excites you most in those areas?
Well, in the area in particular of Web3 and the metaverse, really, the thing that is interesting, fascinating, is just this new concept, which is new really with the blockchain, is that a digital asset can exist uniquely. The concept, a digital asset can be owned and can be unique. Like that's the basis of cryptocurrency, it's the basis of NFTs, and that can impact a lot of businesses where no one would have previously accepted or believed that. And we're at the very earliest stages of what that looks like in terms of how businesses evolve. I'm not sure exactly what it ends up meaning for us and our businesses. It's something that we've started to think about, but that concept, I think, is very profound. And the other overlay on this is if you talk to younger people, last summer I talked to our interns about this, they are comfortable with relationships that exist entirely digitally. I'd say about a quarter of our interns said that they have best friends who they've never met. They only exist digitally. They're some of their best friends. They talk to them all the time online, whether through chat or through games, and they're among their best friends and they've never met. And if you extend that, you'd say, okay, well, if a platonic relationship among young people can exist without ever meeting physically, first of all, you can evolve that to romantic relationships, I think will exist that way. And you can also say, well, those kinds of relationships with goods will exist that way too, which is if you're wearing fancy shoes or a certain brand to impress your friends, then you're going to be doing that online too, because at least 20% of your friends are only existing there. That does have really profound impacts. I mean, there are some scary components to thinking about that, but I think that there is real merit to that having a meaningful place in society 5-10 years from now.
There's been a lot of capital formation out there. SPACs, obviously a lot issued. There's a lot of powder sitting on the sidelines. How do you think it all plays out?
SPACs in general, I think there are many that will never complete, nor should they complete. The thing that blew my mind, we looked at doing SPACs, and then we looked at with some of our companies whether it made sense to go into a SPAC. And the most under sort of reported component to a SPAC that to me was absolutely damning to consider that alternative is the reality that you build a company for however long it takes you to build a company. And then for essentially, because a SPAC can't get done without a PIPE, for essentially 3 months, you hand over the keys to somebody else and say, you're in charge of selling this company to everybody out there in the world. And there's nobody I would hand the keys of one of our companies to for 3 months to go be responsible for our future. And the idea that you have to go do that is, for me, like completely impossible. And you can't say, well, but you could, if for enough valuation, you might do that. The reality is they can't deliver the valuation. So there's no scenario, structurally how the SPACs are set up, they can't deliver anything of value to a company, I don't think. They can't deliver a guaranteed valuation, usually. And they can't, I don't think, generally can deliver a sort of better sales process. Sometimes they can, but I think unlikely they can deliver a better sales process. So the idea that you'd have a good, thriving company and give that the right to a different group of people for 3 months to be in charge of the future of the company while they try and get the SPAC officially de-SPACed, to me is nuts, and it ends up being a adverse selection situation where the only companies who are going to go into that situation are ones who have absolutely no other alternatives and absolutely need access.
But in this environment, could it become more relevant? Or do you see, I think it's $250 billion of cash sitting there waiting in the SPACs, returning to investors to be spent in other ways?
Yeah, so I think the cash will come back. You're right, in this environment, there's going to be a lot of companies that won't have access to capital, who need capital, and who are worthy of capital. The issue is that the SPAC structurally can't deliver that because they still have to go get the PIPE. Mm-hmm. So what's going to happen is they'll go out there and the holders of the SPAC shares redeem, and so there's no cash there when you get to the end. The only way it works is if there's a PIPE with it, and so who's going to go sell the PIPE? If you can go sell a PIPE, just go raise it in the private market. Why do you need the rest of this infrastructure around it?
Joey, a lot of the businesses that you're invested in are international, but I'm sure IAC could deliver value in many different markets directly. What are you doing internationally, and what advice would you have for any companies who actually would see value being part of the IAC family?
Yeah, so our international ambitions have unfortunately always far exceeded our international execution. But that doesn't need to remain the case. And one of the things that you said is when we're entering somewhere new, we can enter a new geography with a business we understand, or we can enter a new business with a geography we understand. Doing both is a little bit harder. Not impossible for us, but a little bit harder. But certainly when we are in a business already, we'd love to meet all the companies who are doing that same business or a similar or adjacent business in other countries, because I think there's a tremendous amount we can learn, and also hopefully some that we can teach on what we learned in that same business in our market. And so we love opportunities like that. We've bought a number of companies for Angie throughout Europe, and Turo just bought a French company called Wecar, which is very similar to Turo in France. And we'd love to keep doing that. We'd love to spend more time in Australia. I'd love to spend more time in Australia, so that's another important synergy.
We have to get you there.
Yeah.
And Joey, family obviously very important to you. With your kids, what boundaries do you set around technology?
Yeah, so our oldest is 13. She still doesn't have a phone. She's the only one in her class who does not have a phone. And to our amazement, she's not actually bothered by that. She takes it as a point of pride. She does have an Apple Watch so that we can communicate with her when she's around and we can track her, and mainly for safety reasons. But she hasn't gotten a phone yet. She gets a phone in August. That's always been the plan. When she has her bat mitzvah, she gets a phone. So that's happening in August, and she'll get one then. But I think that'll probably be the plan for all the kids. I think it's not a fear of technology for us. I mean, all our life, we embrace technology. But I do think there's some social pressures that are introduced based on a lot of the platforms that are out there that we don't think our kids need to endure yet. I think they got the rest of their life to endure that stuff, and so we're taking our time with those things for them.
Well, thank you, Joey. Thanks for the time. Look forward to seeing how your portfolio performs, but also how you spend the close to $2 billion of cash that you have on the balance sheet. But really appreciate the time today. Thank you.
You too, Michael. Thank you.